Today we consider how inflation and even hyperinflation could impact upon the stock market. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Since the crash in March 2020, the stock market has served as a relative safe haven for investors to pile in on risk assets, spurred on by central bank liquidity. This has fueled quite some speculative frenzy, and so while CPI inflation remains modest and yields not too high, stocks are likely to continue to do well on the back of this liquidity. Yet if CPI inflation is running at 4 or more %, it is likely to have a significant impact upon stocks. Indeed, in a famous paper from the late 1970s, Warren Buffett wrote of how inflation swindles the equity investor. There he wrote of how rising yields would impact upon the net present value of future investments. Specifically, raising capital would be more expensive with higher rates of interest, while future returns would be undermined by inflation. In this paper, he states, as the dollar deteriorates month after month, a security with income and principal payments denominated in these dollars isn't going to be a big winner. So what about even more rapid debasement in the purchasing power of currency, such as hyperinflation, where it tends to promote widespread speculative behavior? And of course, we've seen a huge amount of speculation and a retail investing frenzy in recent times, which does draw certain parallels to times gone by. And you can also extend that to the cryptos market. Indeed, many suggest we are seeing the early stages of hyperinflation. Just consider the following quote of the 1920s Weimar Republic, where Adam Ferguson, author of When Money Dies, writes, "The public will continue to be swayed by rumours and to speculate either in goods or stocks and shares. As regards dealing in shares, all classes of the population have for months been speculating with a fine disregard for common sense." And so regarding the performance of stocks, Ferguson goes on to state that scarcity of money was one of the reasons for the precipitous drop in real terms, though not, of course, in money terms, of industrial shares. Towards the end of the summer, in terms of gold, they had fallen to about 1/10 of their pre-war value, a substantial loss for consistent holders of these securities. Although nothing like that suffered by those who held fixed interest stock, whose values were wiped out. So the key theme is that shares will do well in a nominal sense in a hyperinflationary scenario, but will fail to reflect their real values. Indeed, Ferguson goes on to state that in nominal terms, a basket of shares of companies which had not inflated or otherwise altered their peacetime capital had risen between July 1914 and July 1922 by 13.4 times. By October 1922, the share price index dropped to 3/100ths of its real value. And so what about the dividends offered by companies and their equities? Well, in nominal terms they rose, but as an overall yield against the share price they fell, and in real terms against the gold value, dividend payments collapsed in the Weimar Republic. And exactly the same process was seen 90 years or so later in Venezuela, as the Caracas stock market index rose by around 200,000%. But as this Forbes article points out, that the rise was simply in Venezuelan bolivars, stating that the Caracas stock market index was 2018's worst market performer in dollar terms, suffering a collapse of 94%. No wonder Venezuela was so desperate to repatriate their gold back from the Bank of England. The lesson is clear here, however, that sound money remains the ultimate protection against rampant currency debasement, in particular silver and gold, as we considered in this video. But interestingly, copper also demonstrates a very high correlation between its price and inflation. So certain copper stocks may be worth a look, as well as gold and silver miners. And of course, right now we're in a globally synchronized debasement where all currencies are in a race to the ultimate bottom before and ahead of the monetary reset. So we can expect all of those currencies to do poorly against real value, against real hard assets, whether it's gold, silver, whether it's cryptocurrencies. To me, it's all a matter of liquidity preference. The safest store of value over the last 5,000 years has of course been gold. More speculative is of course these digital currencies. Anyway, thanks so much for joining me. Do consider subscribing, and I look forward to seeing you next time. Bye bye.